From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, September 1st. Here are the top market stories that we're following for you at this hour. Jobs just nail it. Labor market paints a Goldilocks picture. Traders start to price out Fed hikes. And that means good news is, good news. Stocks up, yields pop, on the front end in particular. The dollar pretty much stays flat. The market really buys into the soft landing scenario. Do you buy into it? And the state of manufacturing, we get the latest read on the economy with instant analysis from Tim Fiore, chair of the ISM's Manufacturing Business Survey Committee from New York. I'm Alix Steele with Danny Berger over in London. Guy Johnson is off today. Welcome to Bloomberg Markets. It's Goldilocks. Just for how long, Danny?
Yeah, that's the question. I got to say, they're even finding some reasons to maybe sell now. The 2-year coming off some of the biggest declines for the yield that we had seen right after that data.
Yeah, so a little bit of a reversal there. Speaking of the data, we've got ISM Manufacturing crossing right now. Let's go to Mike McKee for the numbers. Mike?
Well, it's a mixed picture from ISM on the manufacturing side. Better than expected on the headline number. Comes out at 47.6. The estimate was for 47. It was 46.4 last month. The new orders index falls to 46.8 from 47.3, but production rises to 50 from 48.3. Employment 48.5 from 44.4. That might have given people a better handle on what we were going to get in this month's jobs report, but because of the calendar, the ISM comes out unusually behind the payrolls report. Inventories 44 from 46. Maybe there's some inventory building to come if consumers keep buying all the goods that they are buying. And prices paid rises to 48.4 from 42.6. Suggests still some contraction, but maybe at a slower pace. So overall, a kind of mixed picture on the ISM front, but I just read the numbers. Tim gives you the analysis on why that is.
Mike, you're more than that. But to Danny's point, we are seeing a move in the market. So the equity market is staying bid somewhat, but the dollar now moving higher, and you are fading a lot of that rally that you've seen in the bond market. You just have 2-year yields down by 2 basis points. Mike, thank you very much. So let's get right to it. Instant analysis with Tim Fiore. He's the chair of the ISM Manufacturing Business Survey Committee. Tim, what's going on here in these numbers?
Well, I think we're in the trough. It feels like we're in the trough. So, in the month of August, we actually beat the 3-month rolling average on the PMI. I look at this stuff from a demand and output and an input standpoint. The real story this month was on the output side. So as Mike mentioned, production was stable at 50, which means that revenues are probably stable too for the month, down a little bit from the month of May, because June and July had a bit of a recovery, but we seem to be slowly crawling back on the demand side. Customer inventories were about right. The better thing is that backlogs actually showed a movement above 40, which for the first time in about 10 months, we've seen that. The big story here, like I said, was on the output side, production. Employment didn't come down to the same extent that it did in the July timeframe, but it's still easing. And the panelists' comments indicate that rather than using layoffs to get the headcount down to a lower level, there seemed to be a much bigger emphasis in August on attriting down, which is a much slower process and more in line with having output meet the demand cycle. Inputs are not an issue. Inputs are still very accommodative. And we can talk a little bit more about the inventory number in a minute.
And in terms of climbing out of the trough, if we're in the trough, given the slow speed at perhaps some of the employment changes that are happening, what will the speed be, again, of getting out of the trough if that's where we are right now?
Right. So we need supplier delivery number to stiffen up, to get above 50. Obviously, we need that new order level to get above 52. That'll then start to drive demand back, and the pressure will be showing at the supplier level. One of the reasons why our number is so low is that the manufacturing inventory number is sitting at a 44, a historical low, which I've been saying now for the last 6 to 8 months that they've been managing their entire supply chain inventory very well. This is just one more indication that people are still positioning themselves for an uncertain future, but in any event, it's putting them in a great position to respond when demand starts to come back. I have no idea how long we'll be in this trough, but we've been running around 47 plus or minus for 4 to 5 months. I think we're in the trough. So given any external influences that don't impact the course, we're probably looking at a slow build out here.
Do I worry about the prices paid moving up so much?
Well, not yet. I think I would have liked to see that number down in the low 40s again for the second month, but still contracting kind of indicates that we're at nearly an equilibrium between where we were and where we want to be. I think there's a lot of arguments going on now at the factory floor level about what people should be paying for prices. The conversations have started about 2024 because everybody has started their budget season now and they're trying to figure out what their profit plan is going to be, and a lot of that has to do with what the input costs will be. So I don't see prices collapsing outside of the the commodity stuff, maybe easing a little bit, and cycling probably more likely than not. But it seems like we're at a price level now that is probably positioned for the next 6 months.
Where are you seeing construction spending the most robust? Tim, what's leading this?
Well, we're seeing more and more activities, especially in the machinery area and then the fabricated metal products area that are high feed-ins to construction. We're starting to get more comments around factory build-outs and capital investment around the infrastructure plans as well as the CHIPS Act. So it's now starting to finally show up. It took a little while, but I expect that to build with some momentum as we go into 2024.
Hey, Tim, this is a totally unfair question, so I'm totally going to ask it. The market has been taking the data as confirmation of sort of a soft landing, Goldilocks scenario, that the Fed doesn't necessarily have to do anything more, et cetera. Does the manufacturing data read that to you?
Well, I would agree with the soft landing thing. It kind of feels like this has been a soft landing. If it feels like manufacturing is in the trough. I don't see anything that's going to turn it more negative. In fact, everything kind of indicates that things will be a little bit more positive. But I can't really answer that last question for the Fed. We'll see how they take this data and what they do with it. That's a much longer term game. But it feels like we're sitting here, and we have been sitting here for quite some time, in a slow contraction, which I think in anybody's definition would be a soft landing.
Can we get back to the inventories question, Tim? What sort of comments have you seen there in this report?
Well, it continues with the overordering, which is pretty much cleared up. There's still a little bit out there, but nowhere near where it was 9 months ago. Customer inventory levels, our panelist customers, are at the too low of about right, the low end of about right, which is good. It's not great, but it's good. So, that leaves supplier inventories as well as our manufacturing inventories. 44 is a pretty strong contraction number. I mean, our manufacturing inventory number generally hangs between 48 and 52.
Yeah.
And here we are now down at 44 when there's lots of pressure on everybody's part to get revenue. So I think it just indicates that we've done a really good job, and the Fed has actually supported this by a year and a half worth of slow decline. We've been able to clean up that entire supply chain inventory to the point where our panelist companies are still contracting inventory at a time when things are really slow. You'd think it would be growing. So I think that's really positive. The only thing we don't really have visibility on is supplier inventories, but the fact that they're delivering faster would indicate that there's more inventory in the supply chain. But I don't think it's overwhelming.
Hey, Tim.
Because if it was overwhelming, they'd be pushing that inventory to their customers.
Hey, Tim, before we let you go, United Auto Workers could be striking. They're asking for a lot in an increased pay deal and labor contract. Are any of your industries or companies talking about that, worried about that, thinking about that?
A lot of companies are concerned about it. Last month we had not only the auto workers strike, but also the potential UPS Teamsters strike. The latter one got resolved successfully. I think there was some pretty significant price wages in there, but that would have impacted every sector across manufacturing and services. In the case of automotive, it will be limited to the transportation equipment and some of the supporting industries. Transportation equipment has been our strongest performer for the last year. So I'd hate to see that get knocked off the rails. But we had a lot of panelist comments concerned about the potential for a strike. It seems like both sides are fairly aggressive here. Hopefully they'll see some common bonds and get to a resolution. But most likely that's going to be a significant wage increase on the automaker side.
Yep, many folks hoping for that resolution. Tim, really appreciate your time this morning, your instant analysis. That's Tim Fiore, chair of the ISM Manufacturing Business Survey Committee. Now, coming up, we're going to get our question of the day. Do you buy the soft landing? The markets at first did, but are they pulling back? We'll be speaking with Mona Mahajan, senior investment strategist at Edward Jones, is our next guest. Now, as we head to break, Nouriel Roubini, the economist who predicted the 2008 financial crisis, shares his outlook for the economy with Francine Lacqua at the Ambrosetti Forum in Cernobbio, Italy.
A 10% correction is not totally unlikely if the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more. I would not be surprised if in the second half of the year they get a 10% correction in global equity markets.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think the Fed should be done. I certainly think, given this number, unless you got something very significant on CPI, I think they're not going in September.
You're seeing the kind of Goldilocks scenario that the Fed wants. I think it'd be really unlikely that they're going to move in at the next meeting.
I think this was the report that the market was looking for.
We're on track for a soft landing and the economy that still chugs along.
The unemployment rate, finally, that stubbornly low unemployment rate, finally ticking up. I think is good news, but you have to be careful, right? The labor market can be a real slippery slope.
Those were some Bloomberg TV guests earlier commenting on the jobs data. So our question of the day, and you can really wrap ISM Manufacturing into this as well. Do you buy the soft landing? As in, like, do you believe in it? Or do you literally go buy stocks on it? Do you want to buy the front end with it? You can go lots of different directions with this question. So joining us now is Mona Mahajan, Senior Investment Strategist at Edward Jones. Do you buy the soft landing, Mona?
Yeah, thanks, Alex. And look, I think to the extent a soft landing means we avoid a technical recession, 2 negative quarters of back-to-back negative GDP growth, and instead see an economy that softens to below trend growth, we think that scenario is likely. And in fact, I think we're in the camp of what many call this rolling recession, where some parts of the economy, and we saw it this morning in ISM, manufacturing is starting to stabilize. You know, keep in mind, ISM Manufacturing still down for, I think, 10 straight months below that 50 level in contraction territory, but we're starting to see a bottoming and maybe even a tick higher. But on the other hand, you have the services economy, which has been, you know, all guns blazing thus far. But this week, we did start to see some softening in services, particularly from a jobs perspective and a wage perspective. So not only the job openings data earlier this month, the ADP private payrolls, but of course, this morning, we got a jobs report that you could argue was softer than expected. And of course, from a Fed perspective, probably in line with what they'd like to see happen going forward. But to answer your question, we think a period of below trend economic growth is likely, probably driven by some softening in the services economy, maybe some stabilization on the manufacturing side. But that kind of fall to a technical recession doesn't look likely as of now.
Well, one person who certainly doesn't want to buy the narrative or buy a large chunk of economically sensitive stocks off the back of a soft landing is Michael Hartnett from Bank of America. I want to read you quickly, Mona, part of his note that he had, I should say, before the report, but said August payrolls is the last piece of the Goldilocks jigsaw. He was looking for a softer report. We got that to some degree. High yield, home builders, and semis to signal a shift from soft to hard. Sell the last rate hike. In other words, Mona, he's saying that high-yield home builders and semis, those have been holding up, and in the months to come, they won't. What do you think of those pieces of the puzzle there?
Yeah, you know, I think generally what we've really seen is the market has been driven just by a very still narrow set of leadership. It's really been 3 sectors of the S&P 500 and really a large cap technology story that's driven the equity market higher. Now, what we would say is, as that component did show signs of cooling in August, we did get a bit of a pullback. But more recently, what's really been driving the market is the bond side of the story. And so I think that's really where the focus has to shift now. If we do see a potential peak in Treasury yields, and keep in mind, historically, Treasury yields tend to peak 1 to 2 months ahead of a peak in the Fed rate hike, or the last Fed rate hike. And so if we think that the Fed is done, we may actually be upon a period of peak Treasury yields. And in that backdrop, what we'd say more broadly is, yes, we're heading into September. We could see continued volatility. But as we look towards 2024, if we are getting inflation continuing to soften, if we're getting Treasury yields that have peaked and maybe stabilizing over time, rolling over, and if we're getting an earnings picture that has gone from flat earnings growth this year to a pickup next year, that's a pretty good backdrop for risk assets.
So where do you dip your toe in, Mona? So where do you dip your toe in that scenario?
Yeah, we'd say generally make sure that you are positioned for that broadening of market participation. We don't think those three sectors and those 7 names are going to drive the entire story going forward, particularly in a period of stable or falling yields. That's a good environment for some valuation pickup across the board. And really, when we think about where the attractive valuation lies, it does lie in areas like cyclical stocks, like small cap stocks, even parts of international, which may start to show stabilization in the next 12 to 18 months. We think those are the areas that we get a lot more opportunity and juice. And then, of course, we look at the bond portfolio. And really, you do want to be positioned for longer duration bonds ahead of any potential pivot lower from the Fed. So maybe you have a little bit of leeway to go, but we'd start thinking about that positioning as well.
Is there still really more juice to get out of long duration, Mona? Isn't there, to some degree, which they've priced in a fair amount of cuts down the road?
I think generally the 2-year has started to show some signs, and that's usually the part of the bond market that's most levered to the Fed, some softening, but we're still pretty much near the highs of the last, call it 24 months or so. I think we did peak at about 5.05 or so on the 2-year. We're at 480 levels. We do think as the Fed thinks about or signals, rate cuts, and probably not likely till mid or late 2024, we could get a more meaningful deceleration in the 2-year. So, if the Fed has indicated in its last set of projections about 100 basis points of rate cuts next year, another 100 basis points or so in 2025, we've only seen about 20 basis points of a sell-off thus far, probably more downside to go.
Mona, the potential for an auto worker strike, are you factoring, how are you as an investor with a longer term thesis looking at something like that? Because if you look at like a 46% increase in wages, even if it's over 4 years, and some of the contract negotiations are tremendously strict, and then the flip side, you have 150,000 workers potentially out of work, which would really hurt the economy. How do you think about that?
Yeah, it's a good point, and it's a mixed picture there because, of course, wage gains have been really what have been fundamentally driving core inflation higher. As wage gains have increased, that's increased labor costs across a lot of services, even the travel, leisure, hospitality, auto, to your point. If wage gains are moving higher, that does keep inflation somewhat elevated and, puts a floor under how low it can go. But on the other hand, if we do see more broadly an economy that's softening beyond just the auto space, we could start to see, as we are seeing, job openings contract across sectors and layoff announcements start to increase as well. We've already seen jobless claims, which have remained pretty healthy, starting to trend a bit lower. And then, of course, the other big one is the quits rate. We are not seeing as many employees quit their jobs because they don't have as many opportunities to find new positions. So all of these are early signals that the labor market broadly is cooling, even though we are seeing, I guess, a unique situation in the auto sector in particular.
Unless Taylor Swift never stops going on tour. That's the only thing that can save us right
joke,
now.
But it's
Beyonce,
true.
Taylor Swift.
Yeah, it is. It's true. They are literally powering this economy. Hey, Mona, really wonderful to get your thoughts today. That's Mona Mahajan of Edward Jones. All right, still ahead on the show, a tale of two tech companies. Broadcom gives a downbeat forecast on sluggish demand, while things are looking up for Dell as the PC market revs up. We're going to have details for you in the startup next. This is Bloomberg.
It is 22 past 7 on the West Coast. Want to get to the startup? We cover the top tech stories from the Bay Area and beyond, which looks cloudy and rainy, by the way, just in case you needed to know, as Silicon Valley starts this morning. Now, joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, I just want to start with Broadcom. Pretty downbeat forecast. What was your biggest takeaway here from their quarter?
It's that no matter what the narrative about demand for their AI-relevant products, they're not showing up in the financials. And that's the difference between Broadcom and what we've seen with NVIDIA is the kind of starkest example. Broadcom makes two types of chips relevant to data centers. One allows for the flow of data between different computers or stacks within the server, and the other is their kind of custom silicon business that they make for data center operators who are carrying out AI function. The forecast for the current period, $9.27 billion, was below the low end of what analysts had estimated and way off from the high end. And I guess the story is this: even if their AI business is growing and there's demand and sales are growing there, the rest of their business is not growing, it's declining. And if you look at the commentary from the call, if you stripped out AI, there wouldn't have been any growth at all.
Then how does it make sense that Broadcom has that lack of growth again without AI, but Dell surprises both on PC and data centers? That is exactly the question I asked this morning. Dell's sales actually fell 13% year on year in the quarter gone. The outlook that they gave for the current period, $23 billion for the fiscal quarter ending in October, was way above expectations. For them, the story is kind of more analogous with what we've seen with the names that are telling us that the end markets are bottoming out. Dell is a story about corporate spending. It's almost a sort of crystal ball into what the corporate spending environment looks like. Yeah. And analysts are buying into it, that AI will be a long-term tailwind for them, but things in their core business are stabilizing.
So, okay. Interesting point. You guys show the money, and there's other, and if you're just a pure player versus a conglomerate, and also show the money. Okay, so Charter didn't show Disney the money.
They did not.
This feels like a very problematic issue if you're not going to have Disney on Charter Communications cable customers anymore.
Yeah, so Charter is the second largest cable provider in this nation. It provides television services to 14 million people. And what Disney said overnight is that they are going to block Charter customers from accessing specific linear television channels, most importantly ESPN, right ahead of the football season. I'm not a football fan, but there are millions out there who would be worried by this. And the problem is it goes to the core of the Disney story. Disney wants more value for their channels, for their product. Charter wants to improve its bottom line. And basically the root cause of what Disney justifies the block on is they're in a contractual dispute to renegotiate those terms. And since Sun Valley Disney earnings, we've talked about this, right, Alix?
Yeah.
How does Bob Iger think about the legacy TV business?
Right.
It's changing.
Yeah. Honestly, I just don't even understand how you watch sports in the U.S. The whole thing is very confusing to me. Ed, thank you very much. Bloomberg's Ed Ludlow, who, of course, will be on Bloomberg Tech coming up in around 90 minutes. All right, coming up, we continue the payrolls convo on Bloomberg.
We're about an hour into U.S. trading session. Stocks still fronting a pretty nice rally. It looked like we would roll over there for a second, but we didn't. And volume, the first time I can say this all week, is actually pretty good. Simone Foxman is joining us for more. Simone?
It's kind of surprising, right? Because aren't we all leaving for the Labor Day weekend?
Yeah, how high does volume stay? Let's get to that.
Yeah, well, we can see a positive reaction on these signs of moderation in that latest jobs report. We're looking at S&P futures about 0.5% higher. NASDAQ actually the part of this market that's not moving up so much today, but we're watching the 10-year yield as the yield curve steepens across the curve, 4.16%. Crude higher by about closer to 2%. We're now over $85 a barrel for the first time since November. Back to that in just a second. I want to show you, though, never say the tech rally is over, because info tech stocks are best part of the S&P all week. This was partly led by computing and hardware gains like Western Digital and Seagate. Also, though, some of those tech names getting some love again. You look at Intel and beyond. But if we're looking at today, energy is the story, maybe on the back of that WTI news. We're looking at Devon Energy, Apache, Halliburton shares all rallying here with WTI, as I said, above back up to those November 2022 levels. And the latest headline crossing from the Wall Street Journal that Aramco may try and take advantage here, potentially interested in issuing $50 billion worth of shares. That's according to Wall Street Journal sources. Alex.
All right, Simone, thank you very much. Really appreciate it, Simone Foxman. So let's go back to the jobs number. Hiring picking up in August, wage growth slowing, signaling a moderating labor market. Employment rate ticks higher, but for good reasons. Acting U.S. Labor Secretary Julie Su spoke to me in the last hour about the report.
This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
For more now on the jobs report, we are joined by Tiffany Walsh, PIMCO economist. Tiffany, what was your broad take on the jobs market? I was mentioning to Secretary Sue, that we have good news is finally good news, and that seems to be reflected in the market and the economy. Do you agree with that?
Yeah, I mean, I think this jobs. I mean, obviously, you never want to, put too much emphasis on any one report. But overall, I think the messages that came from this report were overall pretty good. Both in terms of labor supply and labor demand. It looks like it's coming into better balance as Federal Reserve officials want. So we are seeing some slowing in job gains. That's become very clear. The Labor Secretary suggested that the 3-month moving average is 150K. That's down quite tremendously from this time last year. That's good news. But at the same time, you're seeing labor supply increase with the participation rate moving up, and steady gains there as well. So all of this is good news for the Fed. In terms of monetary policy, it certainly takes the pressure off the Fed to hike again in September.
And it was good news for the bond bulls until the ISM data came to ruin the party. Stronger than expected. You have things like new orders still outstripping inventories, a ratio which usually collapses ahead of a recession. What do you make of that data? Does that challenge the idea that things are starting to get softer at this point?
Well, I think you have to be a little bit careful about the ISM data. I mean, overall, it is going to be impacted by what the dollar is doing. The manufacturing sector is part of the global manufacturing sector. And you do get lagged effects when the dollar appreciates or depreciates. Obviously, saw a big appreciation of the dollar last year, and that came off this year. And I think it's giving you a little bit of a boost to the manufacturing sector. Now, keep in mind, however, though, things in China look much worse lately. And I think the downside risks there have certainly grown. And that's going to put, downward pressure on the global manufacturing sector. China does tend to lead that, so I would just be a little bit careful of overly extrapolating some of the bounce in the ISM.
That's what we do. We got to make news every day, even on a Friday before Labor Day. So you mentioned pause for September. What about November now? What's your call on that?
Yeah, I mean, we think there's a lot of headwinds to the economy overall in the back half of this year. Obviously, there's been a lot of discussion around student loan prepayment starts. But in addition to that, just the fact that we've seen tighter credit conditions, that also impacts the economy with a lag. Loan growth this year has been pretty stagnant. And so you are going to start to see those effects. We think they will become more clear in the back half of this year. And in that kind of environment, it's not necessarily clear that the Fed needs to hike again. Now, nevertheless, they're going to come out with another forecast or summary of economic projections in September. And it's not that, it's not clear to us that they actually take out a rate hike. But whether that's actually realized or not is less clear to us. The other big headwind for the back half of this year is the potential for the U.S. government to shut down. Yep. That'll have a temporary effect on the economy, but in the past has caused the Fed, to kind of change course a little bit.
Tiffany, can I tell you a game that I secretly miss, and I guess not so secretly anymore because I'm telling you and all of the viewers, debating what shape this recovery is, what the economy looks like. And what struck me was this report that of SNAP users, so the food subsidies for those at or below the poverty line, that 42% of them skipped meals in August. 55% ate less because they couldn't afford food. That's more than double of last year's share. Tiffany, these numbers are depressing. I mean, is the recession already here for those that are worst off among us?
Yeah, I mean, there's definitely a bifurcation within the economy right now in terms of frankly, the haves and the have-nots. So we are seeing, the lower income folks, they are certainly struggling. They don't have any of the pandemic-related savings, and the increase in credit card balances that we've seen, just from an economy-wide perspective, suggests to us that people are, taking out additional credit in order to, to try to smooth over their consumption. That's not sustainable. We also see that in the savings rate data, the data that came out earlier this week. The savings rate actually dropped, and it's at historically low levels. At some point, that's going to have to correct. And when it does, it's going to mean consumption growth, is going to decelerate. And so, although it's difficult to know exactly when the consumer pulls back, because there's a psychological element there, at some point they're going to have to, and that's going to be additional slowing for the economy.
So Tiffany, wrap in then a potential United Auto Worker strike. And I appreciate that we're gaming something out, but nonetheless, talking about lower income consumers already struggling, and then what we're going to have 150,000 potential people out of work because of a strike. How do you think about that in terms of the economy?
Yeah, I mean, so the strike has, I think many dimensions to it in terms of potential economic implications. So on the one hand, if they're able to get the wage demands that they're asking for, that just is symptomatic of the fact labor markets are tight, and people are able to bargain to get back some of the real wage gains that they lost since the pandemic. And so, ultimately, that's good for the welfare of those folks. Of course, there's going to be some volatility in the meantime as you have negotiations that are happening, and there could be some production disruptions in the auto sector. So that will be, put some upward pressure potentially on inflation, downward pressure on growth as that's happening. So, this is one, economists always have to smooth through noise. Not to say that this is noise, but this is temporary, probably going to be temporary. You got to smooth through this to try to see where the underlying momentum in the economy is.
What about higher gasoline prices? To what extent does that represent a threat to rebuilding inflation again?
Yeah, I think the inflation, obviously, I think the bigger picture for inflation here, energy prices will always be volatile, and certainly higher energy prices matter for consumers' disposable incomes. And so that is hurting. As we discussed. But in terms of what the Fed officials are concerned about, they want to know where the underlying trend in inflation is. We've kind of defined that in the context of the underlying trend in inflation absent any increase in the unemployment rate. And that still looks like it's maybe like 3.5%. So I think we still are seeing higher wage inflation as you suggested. And although these pandemic-related effects are fading, and that's putting downward pressure on inflation, you still have to be cognizant of those underlying trends and where they are versus the Federal Reserve's target. I think ultimately that's why they're in restrictive territory, and they're sort of signaling that they're going to remain in restrictive territory for a little while here.
Tiffany, I know it's still morning there, but hopefully now that we have both the ISM and the jobs number, you can go enjoy your Friday. Thank you for joining us. Thank you for starting it here. Tiffany Wilding of PIMCO. All right, coming up, Grayscale gets ready for a fee war with BlackRock and other firms known to undercut on ETF fees. We're going to take a closer look next on ETF Friday. This is Bloomberg.
This is Bloomberg Markets. You're looking at live pictures of the principal room. Coming up, CoinRoot's CEO Dave Weisberger joins Bloomberg Television at 1:30 p.m. New York time. This is Bloomberg.
We are committed to lowering fees when GBTC converts to an ETF. We'll obviously have to come back on and talk to you about what the fees are when that conversion actually happens.
That was Grayscale CEO Michael Schonenstein. I'll speak well in a second. Speaking to us earlier this week on news of a federal court that has cleared a path for a spot Bitcoin ETF. Now, Grayscale's Bitcoin Shares Trust saw a big jump this week after that landmark ruling. We are off the highs here. And one issue that will impact the profitability of the company is fees. Joining us now for more on ETF Friday is Bloomberg ETF IQ co-anchor Katie Greifeld. Katie, what's the fee structure that's different between the trust and a potential ETF?
So the trust, when the Grayscale Bitcoin Trust started trading, it was really the only game in town. So really they could charge almost whatever they wanted. So they charged 2%, and you heard from Michael Sonnenschein himself that they're committed to lowering fees. How much they're going to need to is a big open question, because you think of some of the other issuers that have active filings with the SEC right now. We're talking BlackRock, Invesco, Fidelity. These are well-known asset managers with big, low-cost lineups. And I spoke to a few analysts for this piece, and some of the predictions range from maybe, some of these spot products will charge 20 basis points, maybe 75 basis points, maybe 50 basis points, probably below 100 basis points. And remember, you go back to GBTC, that's 200 basis points.
I mean, I think about the brand power of Vanguard, of BlackRock, and getting ETF assets. Even besides the fees, let's say they're all able to have something similar. They all get a product at the same time. I mean, does Grayscale really stand a chance?
It's a great point, and I will say that when you think about BlackRock, obviously they like to come into a category and light that fee war right off. In this case, I mean, first mover advantage, Danny, as you know, it's extremely important in ETFs. If GBTC was able to convert, maybe it's less important because they already have, $16, $17 billion of assets under management. But the interesting wrinkle there is that GBTC doesn't allow for redemptions. If redemptions are allowed, which is a key point of the ETF structure, how much of those assets come out, redeem their shares? That could be interesting here.
Well, also, it just really depends on what kind of ETF you're going to be offering, right? Are there going to be options tied to crypto or Bitcoin? Is it going to be a physically redeemable ETF? Is it just going to track? Like, it all depends on sort of what it's tracking too, meaning how much people are willing to pay for it.
It's a great point, especially on the options side. I mean, you think about, if you look towards the ETF world, for examples, you have SPY. That's the biggest, most well-known S&P 500 ETF. It charges 9 basis points. You have competing products from BlackRock, from Vanguard, that charge 3 basis points. But SPY is the biggest because people love the liquidity. It trades like water. The bid-ask spreads are really minimal there. So it's possible that when it comes to the fee war here, that investors will gravitate towards the most liquid product regardless of price. But again, when we're talking about the S&P 500 example, we're talking about 6 basis points. We're not talking about 150 basis points of difference.
Yeah, and I guess how are people going to use these things? They're going to trade it or hold it for the long term. Katie, when are we going to hear from the SEC? When are we going to hear about any more approvals potentially of a spot Bitcoin ETF?
Well, for specific to the Grayscale case, of course, the SEC has 45 days to respond. We'll see what happens there. When it comes to the long line of spot Bitcoin ETF applicants, we actually had some news last night, the SEC, and this was expected. They delayed making a decision on some of the outstanding applications there. That includes Bitwise, VanEck, Invesco, Valkyrie, WisdomTree, BlackRock. The list goes on. The next big date to watch there is October 16th. Maybe we are expected to get a decision then. What decision we actually get, whether they kick the can again as they have done the past few deadlines, or whether they actually make an outright decision, remains to be seen. But it's going to be a really fun fall for people both in the crypto and the ETF industry.
That is the nerdiest thing I've ever heard you say, Katie, and I love it. Katie, thanks so much for joining us. Bloomberg's Katie Greifeld there. And you can, of course, catch her again at 1 p.m. New York time today on Bloomberg Real Yield. Colin Martin, Charles Schwab fixed income strategist, will be joining her. All right, coming up, former Senator and MF Global CEO John Corzine's critics are trying to stop him from making money. More on that in today's Wall Street Beat. This is Bloomberg.
Here's a story that caught my eye, and you love to love it. It's stake with a side of gosh. In battle, Goldman Sachs honcho David Solomon was reported to be launching a charm offensive that includes dinners at a swanky Soho loft. The Wall Street titan and hobbyist, DJ, has been the center of negative press over smaller bonuses, bad employee morale, and a botched push into consumer banking. So, the dinner parties have been described as, quote, forced and awkward as he tries to, schmooze his employees. And adding to all of this warmth, attendees wear name tags. Danny, nothing says to me swank and fun and chill like name tags.
Like name tags. I mean, he should at least DJ for all of them. I feel like that's the least he could do to spice things up a little bit. I'd go listen to that.
That would so be even worse. You got your name tag, you're like, hey, boss, he's DJing? No.
I'm trying to think if the man on the door here at Bloomberg invited us over for dinner and DJ. I think I would be mortified, but interested. Okay, speaking of names on the door, Alix and I are here in the office today, as we are every day, we're almost every day during the pandemic too. However, the crackdown to get bank workers back in the building is proving tougher on Wall Street, with bosses planning a big push after the summer break. Most banks are requiring 3 days a week, while Goldman Sachs is reminding workers they will be expecting 5. But if you go to David Solomon's dinner party, maybe you're excused today. I don't know.
Does that count? Apparently, these dinners are done at like 9 p.m. So it's not like you're like raging until dawn or anything. But, I find
that's
that
my kind of hours.
Yeah, because banks have been making this very clear, but then you have employees who are still upset about their bonus and their pay, but then it's like, well, don't you have to show up for 5 days? I don't know. I mean, like you said, yeah. I've been in the office since July 2020, so my skew of return to office is completely whacked.
I just think about Jamie Dimon quote. I think he said it to The Economist, where he was basically, look, yeah, I get it. You don't want to commute an hour and a half into work, totally, but you also don't need to work for us also. So that's the trade-off he presented.
That's fair. Anyway, this all leads us to Wall Street Beat, where we look at what's buzzing on Wall Street and the world of banking and finance. And here's another story that everyone's loving to love. John Corzine's critics are targeting his futures trading. Joining us now for more is Bloomberg's Ben Bain. He joins us in D.C. Okay, wait, so break me down the story here. We knew that John Corzine was back a little bit. What's this about?
Well, there's some futures industry executives who a little bit is too much for them, basically. It's essentially, he's had some longtime foes in the industry, going back to MF Global, what happened while he was at the helm. And really what followed that, which was this crackdown, this whole slate of new regulations and scrutiny that the futures industry got following, that incident, which, ultimately about $1 billion in customer funds, if you recall, was kind of, that was the center of what we were talking about here. So basically, now you have a group of industry execs, 3 pretty prominent people who are asking the CFTC, the main regulator for the futures industry here in the United States, to take a fresh look at Corzine. And essentially, the way he's had this little carve-out through his settlement where he could trade futures in a limited capacity, they want him to basically be banned from that entirely. So they want a fresh crackdown on John Corzine, not because necessarily it's something new he's doing or that his firm may be allegedly involved in it. It's just essentially they think his past makes him unsuited to be involved at the current time.
Are there prior instances of this sort of thing, or is it kind of like if the CFTC rather lets you get up and running, that it's unlikely they're going to turn around and say it's not okay?
So there's a little bit of a legal wrinkle here, like there always is in these cases. Yeah. And so the CFTC back in 2020, they passed a new rule, and the argument is that those new restrictions may close that wiggle room that he had to start, trading futures in this limited capacity again. So basically, these executives are now saying, hey, CFTC, you should go back because you passed this rule and take a look at that 2017 settlement and the terms of it that's allowing him and his new fund to start trading again. Now, it's worth also keeping in mind, this same executives tried the SEC to get him to get the SEC essentially to ban John Corzine too in a different capacity, and that was mostly unsuccessful. So this is kind of a long-standing feud. There's a lot of bad blood going back now, more than a decade over MF Global, and it's certainly not going away. It's just kind of a fun New Jersey story. I guess fun to read, maybe not fun if you're stuck in the middle of it, though.
Yeah, I was going to say it's probably not fun for the man himself to read, and especially with those comments in that letter. That was harsh. Hey, Ben, thank you so much. Bloomberg's Ben Bain there. All right, as we head closer to the European close, I want to give us a check-in on markets. I was going to say I was going to have a really dramatic market check for everybody, but everything has calmed down. We've undone so much of the market moves post-jobs report. That ISM, it's Friday, my words are getting jumbled. That ISM report really shook things up yet again to the opposite direction. So let me walk through it. European stocks, those were up. They continue to rally, led by energy stocks, thanks to oil prices, thanks to OPEC, thanks to China. But the NOKI, this one was interesting because NOKI has been such a laggard this year because of the rate hikes that we've seen from the U.S., that yield differential. And it really started to gain post-jobs report that it seemed like we were at the peak of the cycle. All of that has been undone, and the dollar's now gaining against it. Two-year yields in the UK, gilt yields, those are moving barely lower. Again, they did have more of a dramatic move alongside U.S. yields post-jobs report. We started to price out BOE hikes. We've had a lot of dovish, shall we say, commentary from Hugh Pill. But again, we've started to undo that. Okay, coming up on the European close, we're going to be speaking with Liberium Head of Strategy. This is Bloomberg.